Hello, this is Jordan, and this video is being recorded on the early afternoon of Wednesday, March 16th, 2016. And today, in this very short video with this one chart here, I want to talk to you about what happens in new bull markets following a devastating or just really bad bear market, and just looking at and analyzing the commitment of traders, or the CoT, in that context. And although, I mean, this is a chart of the CoT, and before we get to that, just a couple comments I want to make. One thing you notice after watching markets for many years is after really bad bear markets, the new bull market that develops, it takes a while for it to have a big correction. I mean, unless it happens like right away and it's having a double bottom or making a slightly higher low, that happens sometimes. But other than that, once the new bull market gets going, it really does not have a major correction or a big setback like in the first year. Like you rarely see that. And the corrections that do happen, they tend to happen really quickly. I mean, it can happen over a couple days or a couple weeks, and that's that. And the market just absorbs that and keeps moving higher. And major examples of that, just look at the stock market after the 2002 and 2009 lows. I mean, I remember looking at the stock market in late 2003, early 2004, thinking, you know, this market has to have a correction. It's gone up too far too fast, and of course it never really happened. I mean, the market kind of from 2004 to 2005, it just kind of grinded higher, the stock market that is, but it never had a real major setback. And the same thing really happened after 2009. I mean, it had a huge V bottom, and the market just kept going higher. And I mean, it did have I think maybe a 17 or 18% correction at some time in 2010 and 2011. It had a 19%. But anyway, I mean, that was more than a year after the major bottom in the market. So what I'm talking about is really what happens after the first year. And let's talk about gold, because gold's a little bit different. It's a lot more volatile. And just looking at major gold lows, I mean, looking at what happened after the 2001 low and the 2008 low, in the miners, well, I should say the late 2000 low. I mean, there are some differences there. It doesn't follow perfectly, but I mean, to where we are now, you know, looking at the miners in my own index, they've had 10% corrections in the last 5 weeks, but they've been really quick. They've happened like over a day or two, and that's been it. Now, I did write an article a couple weeks ago talking about how GDX, that's basically on the same, its rebound has been very similar, both in time and price, to what happened after 2008. And at that point, the miners had a 20% correction. So that wouldn't be out of the ordinary for the miners to have a 20% correction. But I mean, it is coming out of the worst bear market ever. I mean, it probably will have a 20% correction at some point. If it's not now, it'll probably happen at some point this year. But I mean, even if that does happen, I think the miners are going to continue to move higher, because when you follow a really bad bear market, and again, for the miners, they're following the worst bear market ever. I mean, well, to be specific, it's the worst in about 90 years. But when that happens, the next new bull market, it keeps rising and rising and rising. And I mean, if it does have a pullback, it happens very quickly, and then it keeps rising. And we're seeing that again today, where coming into today, you had the Fed decision, and some stocks I follow were down 20%. I mean, again, we're talking about risky junior miners here. They're very volatile. And but overall, GDX and GDXJ were not down. We're down something like 10% or 12%. From the high. That's at their lows yesterday. So it was possible that these things could correct, and it still is even after today. I mean, this could be a false reaction. But still, with the way they've reacted today and the day before they put in a little bullish hammer, I mean, you could think that miners they're not going to have that big correction now. Maybe it's going to happen later. And, you know, one thing to kind of tie this all together, and looking at the CoT and looking at new bull markets, one thing that I really want to strongly point out is in new bull markets, we're talking about in the first, within the first year, like the first quarter, the first 2, 3, 4 months. When sentiment gets really bullish, that is not a sell signal, because sentiment, look, it's a contrarian indicator, but it doesn't always work perfectly. And when people are getting really, really bullish just a couple months after the market was in its worst bear market ever, I mean, that doesn't mean that everyone is in the market. I mean, there's still tons of people on the sidelines who are waiting to get into the market. And that's why we see these new bull markets that follow really bad markets. They tend to just keep going up and going up for the first year, even with sentiment staying in bullish territory for long periods of time. And again, that's because there's just too many people on the sideline that they're waiting for a pullback to buy in. It pulls back a little bit, they get in. There's another pullback, somebody else gets in. And that's just what we have happening here. And so, a lot of people, and I'm not singling out anyone, but I've just seen a lot of people talking about the CoT, and it's very bad for gold, and there's going to be this correction. And sure, I mean, it's still possible gold could test maybe 1180 or 1200, but I mean, people are applying what happened in the last 4.5 years in that bear market to what's going on now. And well, just because the speculators buy in and the commercials have these huge short positions, and gold's going to go down, and everybody who just came in, they're going to be in a lot of trouble. But look, looking at the CoT, I mean, the net position, the net speculative position, again, I measure these as a percentage of open interest, as of last week was 39%. Now, if you're in a bull market, you go back to 2001, 2012, 50 to 60% was that's really the high point most of the time during the previous bull market in gold. And now we're at 39%. So, I mean, conceivably, that could continue to 50% or even 60% until we get some sustained pullback in gold. I mean, just look at the gross short position. It's at 22%. And if you look at when we were in the bull market, the gross short position, it bottomed around 10%, even went lower a few times. And so there's more room. There's more room for people to get in if you're looking at the CoT right now in the context of a bull market. Now, the last thing, which it seems everybody has completely missed with the CoT, is look at open interest. Last week, open interest surged. It surged to the highest level basically since gold peaked in summer 2011. It was the highest level in about 4.5 years. Now, why is that important? If you look at now, open interest is a lagging indicator. It's a confirming indicator, a lagging indicator. It's not going to tell you what's going to happen the next week or the next month. But, I've highlighted here on the chart, you can see late 2001, at the end of 2008, I mean, this is a couple months after gold bottomed. It had those important lows. The open interest really started to surge, and then, gold, of course, increased strongly with that. But those surges in open interest, I mean, that was confirming that a new bull market had started. I mean, typically you want to see open interest rise with the market. If the market's having a good move, you want to see open interest rise strongly with that. I mean, that confirms that you're in a bull trend. And so the huge move in open interest in the last couple weeks to a new 4.5-year high, I mean, that is confirming that we're seeing a new bull trend in gold. So people who are looking at the CoT and just saying, oh, it's outright bearish, they missed what's happening with open interest. That is a bullish point. And I mean, you can even look at times in 2005 and 2006. I mean, whenever gold has had a big move, open interest has also had a big move, basically confirming that big move in gold. So again, open interest is not really a leading indicator. It's more of a confirming indicator. And what we've seen the last couple weeks, that's really confirming what has happened as far in gold, as far as having a major turn, a major shift from a bear to a new bull market. And look, we can even see, I don't have the silver chart here, but the CoT for silver looks even worse if you're just applying that bear market analysis. Now, a couple weeks ago, I noted that the net speculative position in silver recently was at a 5-year high. Now, it only happened by a little bit, but it was at a 5-year high. Silver was acting really, really poorly, and so my knee-jerk reaction to that was, well, silver's going to break down. Silver looks negative. What happened? Well, silver, I mean, it hasn't done anything since then, but it hasn't broken down. It's just consolidated below $16, but it hasn't broken down like the CoT said it should. And in addition to that, look what's happening with the silver stocks. I mean, they are ripping higher in the last couple weeks. So the silver stocks are telling you that silver is probably going to break out, even though looking at the CoT, you'd get the opposite reaction. So, I mean, just a couple final comments here. Just be careful with the CoT and having kind of that knee-jerk reaction to it every time it would tell you that, well, you know, the dumb money is buying in, you know, the dumb money is getting long. Look, the speculators, I mean, for gold to keep going higher, for precious metals to keep going higher, for any market to keep moving higher and being a bull market, you need more speculators to come in and keep buying and buying. So that's what you need. So if gold's going to continue to move higher, the CoT is going to continue to look worse as far as, you know, that textbook knee-jerk reaction type of analysis. And the last thing, which I've already said, you got to be careful when a market is changing from a bear into a bull, and also from a bull into a bear. I mean, when a market is coming off of a major bear market, sentiment can look really bullish in that new bull market. It can look really bullish right away, and it can throw you off. So we have to be careful looking at that. So I know I've said a lot in this video, but if you want to follow more of my work, you can go to dailygold.com. You can get a free copy of my book, dailygold.com/book. Thank you all for listening and watching, and I wish you all the best. I'll speak with you again soon.